Hey, everybody, and welcome back to another episode of the Small Business Ahead podcast. My name is Gene Marks. I'm here with John Adakonis. You are about to hear a really interesting conversation with Kelly Nelson. He is a VP of Business Development at TCI Capital. It's tcicapital.com, and they do factoring. John, before we had this conversation with Kelly, please, how familiar were you with factoring?
So not much. I think I've heard the term before. I loosely understood the concept of kind of like selling invoices.
Yeah.
But I think he gave a lot of good context, a lot of good, parameters and reality on what it is, what it isn't. I think the closest I'd ever kind of been to thinking about cash flow that way is years ago, working in fashion wholesale. We had what are called jobbers. So if you had an excess surplus of clothes, maybe from a season before that you could white label or something, you could sell excess inventory at less of a cost to try and recoup some of like what you spent and get some cash in bulk.
Sure.
But to think about it from money you haven't received yet is just kind of an interesting way to kind of put some cash back in your account versus like into the universe,
Yeah, I agree. And, the takeaway that I got from this is that I always thought, maybe because I have a few clients that factor an invoice at a time, but that's really not the idea. It's like a long-term relationship that you have with a company like TCI Capital that provides this financing for you. They like to, factor more than one invoice. They want to be, doing that, for multiple invoices, but there's pros and cons because you give up, you're going to have to make sure your clients know that there's somebody else that's getting this money, and there are fees involved. Kelly will explain anywhere from 1% to 3%. And also, factoring is not it's not a collection thing; it's a cash flow thing. Clients that I have that use factoring companies are doing so because they've got some customer that's not going to pay them for 90 or 120 days, and they need to get the cash in now so they can pay their bills. So that's where you're using it. This is, again, it's not any kind of a sign of that you're in financial trouble or a collection issue. It's not. It's just to help mitigate cash flow challenges that you have with big projects that are extended out. So, Kelly's, I thought it was great conversation. I think, if you're listening to this, you're going to enjoy this conversation as well. Again, his name is Kelly Nelson at TCI Capital, and we'll be back talking to Kelly in just a minute. Hey, everybody, and welcome back to the Small Biz Ahead podcast. Glad you made it here. My name is Gene Marks, and I'm sure you are well familiar with my co-host, John Adakonis. John, I'm glad that we are here. We have a lot to talk about because this is the money week as it is. We're talking about all things financing and raising money and managing money in your business. And today we have a real interesting conversation that we're going to have with Kelly Nelson. Kelly Nelson is a VP of Business Development at TCI Capital, which is tcicapital.com, is Kelly's website. What's going to happen, for those of you guys listening, as typical, I've got a bunch of questions for Kelly. I'm going to turn it over to John. He's going to have a bunch of questions for Kelly. I will see if Kelly is still standing at the end of our conversation. So, Kelly, thanks so much for joining us. I'm glad you're here.
Yeah, thanks for having me.
Sure. So first of all, just a brief overview. Give us a idea of what TCI Capital does. Where are you guys located, by the way?
We are in Edina, Minnesota, which is a suburb of the Twin Cities, predominantly Minneapolis, just south of it.
Got it. And what do you guys do?
We do. We were purchased by Fidelity Bank. Now, probably not the Fidelity Bank that everybody knows, or Fidelity Investments. We're owned by a company that's been around for now 51 years, Fidelity Bank, smaller local bank here in Edina. And they purchased us right at a little over 3 years ago. We were a private company, and then the owner sold out and we're purchased by a bank, and it's been great, right. So that aspect of it. And we do accounts receivable financing, also known as factoring. And we get companies paid on their invoices right away so they can cash flow their business and a lot of times, grow their business.
Okay. So let's talk about factoring, because when I talk to clients about different ways of financing, like, we can get a bank loan, or we can not pay our vendors, or we can raise money in other, in other crowdfunding if we want to do that, or, loans from family or friends. Whenever I bring up factoring, there's been this historical stigma to it, which amazes me. So I want to clear that up and have you, you're in the business of doing this. So clearly this is a legit business model for a lot of good companies. So Kelly, let's insult the intelligence of our audience and just explain to all of us just what exactly is factoring. Give us an explanation.
Right. And so what factoring is when you are doing business with another business, right? And
Right.
you have completed the work, or you've sold them a product or service, and you have that invoice and you're going to turn it into accounts payable now for payment. Well, those companies may not pay for 30, 60, even 90 plus days on those invoices. And obviously that is a long time to wait when you have, your bills to pay, you have payroll to make, etc.
Right.
So what we do is we get our customers paid on their invoices right away, turning those invoices into cash to help with their cash flow.
Got it. So I have some. Let's dig into the weeds a little bit. First of all, what types of customers are best suited to this type of financing?
I would say, my 10 years of doing this with TCI, the most that I see is predominantly service related businesses.
Okay.
I provided a service, and we want to get paid now versus waiting. So some of the top industries that we would see would be as staffing companies. You got to pay their people weekly, right? I mean,
So they have that cash flow need.
daily now. I mean, we're seeing that. We're seeing a lot of historically oil field related. Oil companies are really known for having the ability to pay, but really stretching out the payments for the people, the service companies that are doing work for them, such as like hauling water, doing other ancillary work along with that. 60 to 90 days is not uncommon for those. Another industry that's really become hot is the telecom industries, with everything going from, up to 5G. There's so much of this upgrades that they're doing. And so we're seeing a ton of that business, and other industries that are historically known for factoring would be as the trucking industry. So those guys are hauling the loads and they need to get paid right away. I'd say that's probably where a highest percentage of funding factoring companies out there play. We do that. However, I would say the staffing, telecom, and other just general service businesses are where we play. Now, we will and still do a lot in the manufacturing space. So somebody's completing projects and they just need to get paid. That's another one. There are specialty factoring companies out there that will do, for the people that are selling their widgets to Target and Best Buy and all that stuff. It comes in, and then also within the construction industry, it comes with its own nuances and issues. We typically don't play too much in that arena, just because
Right.
it's so nichey, kind of thing.
How about Kelly, government and also international companies? I actually, all of those examples that you gave, I've definitely seen them. I don't know, maybe it's just because of the nature of my client base, but I do have a few clients that do business with the government. You can wait forever. It's like you'll die of old age before the government pays. And they've used factoring companies. Is that also an area, and also international as well, if you could comment on that?
Yeah. So I'm glad you brought that up, because that was one that we do for the government contracts. It is kind of the nuances with government contracts can be is how the agreements are written. Some when you're factoring, and obviously we'll probably get into this later, but it's called the notice of assignment. Some government contracts are easier than others to be able to redirect the money. That's the one thing I will say is when we're doing factoring, that the payments are still made to our customer's name. It's just sent to our bank versus directly to them, because, we don't make a dime until the invoices pay.
Okay, so we're gonna get into that process in just a minute because it's important. And just one final thing is on the international side is factoring an option if I'm, if a customer is over in, I don't know, the UK or Asia or whatever, and I want to get paid quicker.
Again, that's a yes. Again, that's a specialty factoring deal. You got to find a company that would be open to that. For us, they can be doing work overseas or with another country, but they have to be billing a U.S. entity and paid in U.S. dollars for us to make it work. We're just not going to go to another country to go try to collect our money.
Right.
We get paid. So,
Yeah.
but there are things, like credit insurance through, like for instance, there's plenty of companies out there that do that, that offer up some credit insurance that basically back the entity, basically back in the invoice.
That makes sense. And also just to make sure that we're completely clear for anybody listening to this or watching this, this is not a collection thing. This is not like, oh, I've got a bad debt, so I'm going to hand it off to TCI Capital and they're going to go and collect it for. This is a cash flow thing, correct?
Absolutely, yeah. That is another common thing that over the years people are have called up and say, hey, I got this company isn't paying me and the invoice is 180 days old. It's like, okay, that's not what we do. We buy invoices and we base it on their customers' credit, even more than their credit. They can, with us specifically, our customers can have good personal credit or actually kind of crappy personal credit. We really don't care so much about that. We care about, at the end of the day, who's paying that invoice. And, that's because ultimately that's how we're recoup our money. And
and you're the one that's getting, you're providing the financing. You're getting your customers their cash fast so that they can move. I mean, this is not like The Sopranos or something. You're not going after people with baseball bats and collecting money. So fine. Okay, let's walk through the particulars. So let's take me as an example. I've got round numbers. I've got $100,000 invoice for a project with a big customer, and as big companies like to do, they delay their payment, particularly to small businesses. I see that all the time. Meanwhile, I'm paying out for materials and my labor, so I want to factor this invoice. So we'll take just that simple example. How does that work?
Yeah. So what I would want to know is, out of the gate is, how are you currently financing your company now? Do you currently have a line of credit? Or do you have an SBA loan? Are you doing it out of pocket, right? So I want to.
Why do you care? Why do you care how I'm financing my business?
Because it goes back to liens, right? And so whatever we're purchasing in regards to invoicing, TCI, factoring companies in general want to be in first lien position on the invoices that we're purchasing.
I see.
Now, the cool thing about it is there are different ways, even if they do have a line of credit, or if they may have liens on their company, that we can work with the banks to, intercreditors and other ways around that. But going back to your point, so we're trying to find out how they're currently cash flowing the business. And then we also want to know, what they're looking for, right? What is their cash need? Is it, hey, are you growing quick and I need this money because I have more, I need more money to offset and maybe hire people or whatever it is. So we need to understand what their cash need is. And then we can start going into, okay, our rates are going to be based on approximately how much you're billing out per month. And then how long TCI has to wait to get paid once, we buy your invoices.
So I'm confused because I thought this is kind of done on a customer by customer basis or an invoice by invoice basis, and now you're saying oh, I want to know what your cash flow is like, and I want to know what you're billing out overall per month.
Yeah.
Why? I don't understand why you would want to know that. If you can explain further.
Well, I mean, the good thing is we don't have to fund all their customers, right? If they have somebody that's paying quick, they just don't need the financing on that specific customer. But it is important for us to know which customers they do want to get funded on specifically, and then how long we'd have to wait. because that's the information that we would need in order to, best determine which different program to set them up with in regards to funding.
Okay. All right. So let's get back to it. So I've got this customer and he's got $100,000 invoice. And I'm like, Kelly, I need some help. Like, I'm paying money out. And let's make the assumption I got no liens. Let's make the assumption that, my business is fine and profitable. It's just like there's a big chunk of change. And I'd like to, get paid on it earlier.
Right. Yeah. So I'd say, Gene, is this something that you're looking for as like a one-time funding, or is it something where you need it on more of an ongoing basis, right? Because with us, we do month-to-month agreements. We don't lock customers into long-term contracts and all that stuff, like a good majority of companies do in our space. However, we would like them to be able, to fund more than an invoice or two, because we don't charge any upfront costs, to set up with us. And we incur a lot of costs, with lien searches, et cetera. So we kind of need to know what their intentions are, what their needs are, to make sure that we'd be the proper fit for them.
So let me stop you right there and say, like, just if I'm looking to, you work with a factoring company, I have to have a long-term view with this. This should be, what you're looking for is a longer-term relationship, not just some one-off type of thing. Not that you would turn it down, but that's what you would prefer. And your reason from a business standpoint is that you have upfront costs to get these things set up and going. And the idea is that if you have a longer-term relationship, you can spread those costs out over longer term. It just benefits you. So I would want to know that as a business owner, going into like what you're trying to get accomplished.
Yep, absolutely. Okay. Yeah, and so what we do is typically is a 90% advance on somebody's invoices, and then we give them back the remaining 10% less our fee when the customer pays, again, 30, 60, 90 days down the road. And that's why asking and finding out what they're looking to have funded on a monthly basis, the ballpark is fine. We don't need specific numbers. And then finding those payment terms, that will be able to give me the information I need in order to come up with, the rates on that month agreement. And then also, if they're growing, I want to be able to show them, our customers, like, hey, as you grow, you don't have to call us up and say, hey, give me a better deal. I'm doing more business with you. We have programs specifically set up where I call them pricing buckets, right? So if you're billing between, $30,000 and $50,000 a month, your price is X. You got it. Once you hit, let's say, over 50,000 to 100, then it's a lower rate. It goes down incrementally. We review it every 30 days. So that's what I think a lot of customers really like, is that, hey, they're rewarding me and I don't have to go back and bug them and go, hey, give me a better deal. It's automatically happening.
Okay. I have a lot more questions, but John, I got to have you jump in here because I'm going to eat up our entire interview with just me talking. And I'm assuming, John, we can stay on factoring, by the way. And I'm sure, John, you've got, your questions as well that are going to overlap mine. So let me turn it over to you, John. Like, go ahead and fire away.
Awesome. Thanks, Gene. And thanks, Kelly, for joining us. I think, kind of following up on Gene's line of questioning, really, I guess, plainly, who pays you? So when you have that agreement with the business, like at that point, is it the business who's collecting the debt from their, kind of vendor who owes them or kind of client who owes them, and then they pay you back? Or at that point, once they kind of get the agreement, are you kind of servicing the collection and receipt of that payment from kind of the third party?
Yeah, good question. So what happens is we will connect with, our customers will give us a good accounts payable contact. And we do what's just an email out to their customer saying, hey, we're the finance company for XYZ company. And you'll still be paying their company, but here's where the address will be moving forward for payments, right? Or if you're doing an ACH, this is what it is. So we try to still stay as hands-off as possible with that. However, I think something maybe we'll go into maybe a little bit at some point would be is the fact of we do offer our collection services, right? And meaning, hey, but I'll give you an example. So let's say, for instance, your customer doesn't pay for 30 days. TCI, once you're a customer, isn't, calling or emailing them, prior to 30 days and going, hey, where's our money? Like the Tony Soprano, kind of remark. We're not doing that. So for instance, let's say we that get out to say 35 days and we haven't received payment. Our account manager, every customer has an account manager, may reach out to somebody in accounts payable and just say, hey, we've received these payments, but we haven't received anything on, this invoice. Is there anything you need additionally, to make sure that that invoice pays? Very customer friendly, just, almost as if our customer was doing it. But it's just an added service that we do, that our customers trust us and really like us to do, so they can focus their energies on, growing their business instead of chasing their money, essentially.
Awesome. And, I think that the probably big question on everyone's mind is how you guys make money. So you had mentioned there's kind of the upfront cost. You prefer the long-term relationships. It's not really a loan so much as, so I don't think we're talking interest here, but I guess there's some kind of discount rate or preferred rate at which you buy the invoice, right? Yep. So the difference kind of is how, you make money. And I'm wondering how a business owner, specifically on the smaller side, right, can kind of think about that. So there's obviously the trade-off. If you want the liquidity quickly, then you're kind of paying for the access to that liquidity. Yep. And how does that kind of build out? Is it based on like a risk profile, or kind of are there like industry average terms, or how do you kind of think about that?
Yeah, so it's a combination of a few things, right? The how much we're buying a month. We'll create a credit limit for each customer that they have that we're purchasing. So we'll let them know, hey, you're working with this company. They're not very strong financially, right? Or so we'll land up to this number, this amount on this specific customer. So that's one of the things. But then to kind of going back into how we charge as a rate is going to be based, majority of it is how much we're buying a month and then how long we have to wait. So we'll do that 90% advance and then give that customer back the remaining 10% less our fee. Now that fee could be anywhere from under 1% of the total invoice, to maybe on the very high end, maybe 3%. Of that invoice total. Now, if that'd be an example of somebody doing, $20,000, $30,000 a month, and maybe we're waiting, 45 to 60 days as an example. If somebody's, we have companies that are billing out, $500,000 to $1 million a month with us that we're purchasing, those, a lot of times we'll see those rates under 1%, and it's all tax deductible. They write it off at the end of the year. But as you mentioned a little bit ago on it is not going against your balance sheet, right? We're just advancing on good invoices.
Awesome. I mean, it's an interesting way to think about getting kind of money back in your pocket versus on the shelf, right? So right. Do you feel like that you've seen an increase in this kind of during, the implications we've seen from the pandemic because of supply chain backups, or when you think about kind of factoring in general, does it feel like there's more curiosity around it, or kind of more investigation on if it's right for business owners?
Yeah, I think when the pandemic started, I think everything kind of slowed down, right? I mean, so many of the payments and everything else, right. How everything had to be kind of relooked at. But now that kind of things are, maybe obviously not back to normal yet, but businesses are growing and they're needing, especially when they're rapidly growing. I would say the businesses that we're seeing would be as companies that maybe have a line of credit, right? And the one thing that's, that can be a negative on lines of credit is the fact that they may not grow at the rate that you want to grow. I have a customer I just talked to this week where they had a line of credit for $1.5 million. Well, that's great, but they're now billing out $1 million a week, right? And their customers are paying in almost 45 to 60 days. So that math don't add up. They have to come pocket with that money. So we're seeing a lot of companies grow rapidly that need money, and that bank line of credit is just not meeting their needs. Now, I will say that our rates may not be as low as the line of credit, maybe in regards to what they're paying, but there's definitely a lot more benefits, and we can actually be relatively close to fees in regards to somewhat of a line of credit. Maybe not quite as low, but definitely in the realm. And if they're passing up a lot of work, what is that really costing them? So,
right. And do you find, I mean, are people pretty clear, or maybe you can explain to us how it works, kind of on like who's on the hook if the kind of client doesn't pay?
right.
So if you're stepping in and you're like, okay, so we know this is a good account for you, but things can happen, right? I think especially kind of during COVID, we saw that some of the most stable businesses were kind of shaken, or if there is a natural emergency or disaster, if they're unable to kind of pay their debt to the business that provided the service,
Right.
and because of that, you're unable to kind of collect the debt that you bought. How does that start to look? Like, is it really passed on to that person who owed the debt originally? Is there some kind of third party liability where the person who kind of like engaged you in the model is also responsible? And hoping that doesn't happen a lot, but
Yeah.
like, what are the things to consider before you
Yeah.
kind of jump down that path?
You're right. That can happen. I think historically it's 0.5% of every invoice that we buy would ever go to that a place where it have to be purchased back. But in the case where it does happen like that, is now typically our standard, what we call recourse, would be 90 days. Right now, we can make exceptions to that or whatever. But let's say hypothetically, we get out to say day 90 on a customer. On an invoice, and for whatever reason the customer, their customer has not paid. If we feel like we can still collect on that invoice, we can still collect past that, say 90 days. But if their customer is just flat out not responding, or they went out of business, or whatever, they're just not playing ball at that point, then yeah, we have to make a business decision at that point and go, hey, listen, that's why we have this 10% reserve, right? We do a 90% advance, hold that 10% back. Hopefully that would cover any shorts, right? If shortfalls, if that would happen. And then what happens if that does happen is, yeah, the customer would buy back that invoice. Sometimes with the reserve, maybe if it's more, then they would have to take maybe some new billing to offset it, and that's their responsibility to go and collect out on that remaining payment for that customer.
Yeah, and I mean, and that makes sense, right? Eventually, kind of everything returns to where it's supposed to be. So, yeah. But I think it's an interesting thing to consider, because the kind of theme of this week is how to raise different money for different purposes, right? So this is definitely an interesting way to look at cash flow. And I kind of look at it the same way I'd look at managing inventory of your business sometimes. Like, sometimes the money is better on your, in your pocket than on your shelf. This is kind of another way to kind of make sure you have access to that again.
Can I just jump in? I just a couple of quick questions, or just to summarize, Kelly. I just want to make, if I have a supplier who that I owe money to, and they're getting factored through you, do I know that? Am I aware of that? In other words, do I see any difference in payment terms, or in where my money is going to, or the name? Am I suddenly sending my check to a different company? Because I know a lot of people get concerned about that. Like, they don't want their customers to know that there's a factoring company involved.
Oh, sure. I mean, sometimes, people will bring up that issue of like, oh, can we not, contact their customer, at all. We have made exceptions occasionally, but typically when that happens, it would have to be usually 20 to 25% of, or less, of whatever we're purchasing, on a monthly basis, before that can happen. What's called a non-notice. Obviously, we're still having our customer change where the payment's sent to. We're just not contacting their customer in that case. And we do make those exceptions.
Because I would have to be prepared for the fact that if I was dealing with, say, a large client, and I sent their invoices out for you to back to them through you guys, I guess you're going to have some communication with my client, right?
Yeah.
For payment.
Yep.
So I have to have communication with my clients to let them know who you are, and that you're not it's not like a scam or something, or, you know what I mean? Like, yeah, you're going to be hearing from these guys, and this is the reason why I'm doing that. And I think that's an important concern. You also have to explain to, I think, to your customers that, like, hey, this is not we're not in any financial trouble. There's no, whatever. I mean, the reason why we're doing this is for cash flow. You guys take 90 days to pay me.
You're their bank.
Does that make sense, right?
Yeah. Exactly. Where the good thing about that, Gene, is most of these we call them debtors on our end, because our customers they pretty much usually know what a factoring company is, right? So occasionally we run across it where they don't understand that aspect of it. It's becoming it's so infrequent now that most of the customers and we always try to reiterate to our customers is, hey, check us out. We've been around for 27 years. TCI has.
Mm-hmm.
We're A+ rated with the Better Business Bureau. Check us out in regards to that. And we are always gonna put ourselves in a position to get the information we need with less push. It's as they would. We will incorporate them. We'll even work with our customers to say, hey, if you'd rather have the first communication with your customer to find out what's going on, so be it. We love it. Just include us on the email that you send out there. Find out what it is. So we work with our customer to say, hey, it isn't all or nothing. We're going to reserve the right to connect with them if we haven't got paid. But we will always give our customer, if that's how they want to go that route, if they need that extra assurance until they build that trust, then so be it. We want to work with them to feel comfortable that they can absolutely make that point of contact to find out what the issue is and work with them to let them know that, hey, it's not paying maybe because they're missing a document.
Sure. And one final comment that I have, again, for those of you listening or watching this, is that, it's important to know